vpod.ai, your source for information. This podcast is sponsored by Stonefly, your trusted solution provider and advisor in enterprise storage, backup, disaster recovery, hyperconverged in VMware, Hyper-V, Proxmox cluster, AI servers, and public and private cloud. Check out stonefly.com or email your project requirements to sales@stonefly.com. Hey there, and welcome to the Deep Dive. Get ready to jump into a really essential topic for anyone building a contracting business, particularly here in California. We're not just talking about licenses, though. We'll definitely cover that. We're really looking at the core business, accounting, legal stuff you need to know.
That's right. We'll unpack the fundamentals, pulling out what's most important, so you can really understand how to manage your business effectively.
Yeah, think of it as a shortcut. We want to help you find those aha moments. So let's get into it.
Okay, so let's unpack this. You've passed the state exam. That's huge. Congrats. But what's next? There's a big decision right away, isn't there? Activate the license or inactivate it.
Exactly. And before you even make that choice, the absolute first thing is paying the state license fee.
Okay.
And it's got to be a check or money order, payable to the contractor's state license board. No cash. That's key.
Right, no cash. And this is different from the exam fee, right? This is the actual license fee for the first couple of years.
Precisely. The exam fee gets you tested. This fee gets you licensed. Two different things.
Got it. And if you choose to activate, there's the bond requirement too.
Yes. You need to get a surety bond. There are companies that handle that, and you can get help finding one.
Now, this next part seems really critical to timing.
Oh, absolutely crucial. You have exactly 90 days. 90 days after passing the exam to either activate or inactivate.
And if you miss that deadline,
you risk having to refile the entire application all over again.
Oof, you definitely don't want that headache.
Yeah.
So 90 days, mark it on the calendar.
Definitely. And once it's active, you got to keep it active. Renewal is every 2 years.
2 years from the end of the month it was issued, correct?
Yeah, that's it. So issued in June, renewal due by end of June, 2 years later.
And the address thing sounds simple, but important.
So important. If you move, tell the board immediately. They mail renewal forms to the address they have.
And the post office won't forward them?
Nope. Not forwarded. Miss that notice, and you could easily let your license expire.
Which means big trouble. Contracting without a license, delinquency fees.
Yeah. Serious penalties and extra costs. Just stay on top of the renewal.
Okay, license handled. But you need a business structure, too. That's another big decision early on.
It really is. The main options in California are sole owner, partnership, or corporation.
And the business name itself matters a lot, doesn't it? First impression.
Huge first impression. It can attract customers or, turn them off before they even call.
So, thinking about the name and the structure, when's the best time to decide? Ideally, when applying.
Ideally, yes. But the absolute latest is when you're getting that bond and paying the initial license fee.
Because,
Yeah.
and this seems vital, each structure needs its own license number.
Correct. Sole owner gets one number. If you form a partnership later, that's a new number. Same if you incorporate.
Wait, so if I start as a sole owner, then incorporate later, I can't just, update my existing license?
Nope. Completely new application, new fees, everything.
Wow, okay, that's a serious heads up. Decide that structure early to avoid doubling the work and cost.
Exactly. Make that call up front. Now, you can do things like a DBA, a fictitious name, under a structure.
Right, doing business A's.
Yeah, but the underlying entity, sole owner, partnership, corp that needs its own license. Decide early. Which, brings up the question, who actually holds the license qualification for that business? The qualifier.
Ah, right. The person whose experience backs the license.
Yeah.
Different types, depending on the structure.
That's it. For a sole owner, it's usually the owner. Partnership, a partner. Corporation, often an RMO, responsible managing officer. Or for any type, you could have an RME, a responsible managing employee.
Okay, RMO versus RME. What's the practical difference there?
Well, the RMO is typically an officer, part of the company leadership, responsible for operations. The RME is an employee whose job includes being the qualifier. Their qualification is tied to their employment status.
And relying on an RME, there's a significant risk involved, isn't there?
A huge one. This is critical. If that RME quits, gets fired, whatever the company has, only 90 days.
90 days.
To do what?
To replace them with a new qualifier. Fail to do that in 90 days.
The company loses its license.
That's right, license gone. It's a major vulnerability if your whole business depends on that one employee's license.
Wow, that's tight. Now, what about one person qualifying multiple businesses? Can someone do that?
Yes, actually, it's pretty common. Someone might have their own sole owner business, be a partner, qualifying a partnership, and be the RMO for a corporation.
Okay, wearing multiple hats. Is there a rule for that?
There is. It's often called the 20% rule.
Yeah.
Generally, the qualifier needs to own at least 20% equity in each company they qualify.
20% ownership. Unless they own 100% of one business, then they can still qualify others as long as they meet that 20% threshold in those other companies. This brings us back to the RME rule, actually. There's a pretty strong warning about becoming an RME for someone else.
Yeah, it sounded like it could really hold you back personally.
It absolutely can. If you agree to be an RME for another company, you have to inactivate your own individual license.
Give up your own license.
Yep. You become their employee. Typically, you have to work for them like 30 hours a week minimum, manage all their projects. You're basically putting your license entirely in their hands.
That's a big step back if you wanted your own thing. The advice on that seemed pretty direct.
It was. Instead of just being an RME, the suggestion is try hard to negotiate for at least 20% ownership in their company.
So you can qualify them and keep your own license
Yeah.
active using that 20% rule.
Exactly. Keeps you independent, gives you a stake, much stronger position.
And if they say no to ownership?
Well, then the advice is pretty blunt. Ask for a lot of money because you know money talks.
Right, because you're taking on significant responsibility and giving up your own license path.
Precisely. It highlights the value you bring and the risk.
Okay, so license is sorted, structure decided, qualifier identified. Now, the money. How do you fund this thing?
Right. Capital. And we're not talking Sacramento. Financial capital.
Gotcha. To start small, maybe you don't need a ton, right? Truck, tools, drive.
Often, yeah. You can bootstrap the first few jobs. But for bigger projects, hiring major equipment, you need more cash.
And the two main ways to get that are borrowing or equity.
Correct. Borrowing is often the more straightforward path initially. Getting loans.
Different kinds of loans mentioned. Short term.
Yeah, notes payable, usually 30, 90 days for quick cash needs.
Yeah.
Then intermediate loans, maybe 1-7 years, common for buying equipment.
And long-term loans.
Or mortgages, yeah. For buying property, buildings, longer time frame.
SBA loans are also an option. Small Business Administration.
Yep, they're another potential source for borrowing.
Okay, so borrowing is one route. The other is equity funding. Remind us what equity means here.
Equity is ownership. Simple as that. So equity funding means getting capital by selling ownership in your company.
So how does that work with the different structures? Sole owner versus, say, a corporation?
Great question. As a sole owner, you have 100% equity. It's all yours. In a partnership, equity is split, maybe 50-50, maybe something else based on investment. You give up some ownership, but you gain capital from your partner.
Well, partnerships seem to come with a warning label.
They often do. They can get complicated. If you do form one, get absolutely everything in writing. A solid partnership agreement is crucial.
Then corporations. More options for selling equity.
Yes. A corporation can have one owner or many shareholders. You sell shares, which are pieces of ownership, pieces of equity. It's a way to raise potentially large amounts of capital. But yeah, the more shares you sell, the smaller your percentage of ownership becomes. And connecting this back, there are some big advantages to incorporating, especially for contractors.
The main one being liability protection,
Yeah.
like protecting your personal stuff.
That's huge, yes. The corporation is a separate legal entity. It can be sued, it can go bankrupt, but usually the owner's personal assets, house, car, savings are protected. Limited liability. That's a massive reason it's often recommended in construction.
That alone sounds worth it in this field. Other benefits.
Well, the corporation can build its own credit history, get corporate credit cards, loans, separate from your personal credit.
Okay.
Plus, corporations have employees. Even the owners can be employees. That opens doors for salaries, potential benefits packages.
And they can fund growth internally, too.
Exactly. Instead of paying out all profits to shareholders, a corporation can keep some back. That's called retained earnings. You reinvest that profit right back into the business. More equipment, bigger jobs.
All right, let's shift gears to maybe the most critical part. Understanding your business's financial health.
Yes. And this is where getting an accountant or a good bookkeeper, someone who knows construction, is just invaluable. You need reliable financial statements.
Flying blind is just not an option if you want to succeed.
Not at all. The two basic statements are the balance sheet and the income statement.
Let's start with the balance sheet. What's that telling us?
Think of it like a financial photo, a snapshot. It shows exactly where your business stands financially on one specific day, usually end of the month, quarter, or year.
And there's that acronym, ALE. Helps remember the parts.
Right, ALE spells AIL. A reminder to check the health of your business. A is assets, L is liabilities, E is equity.
Okay, assets. That's the good stuff, what the business owns.
Correct. Things of value, usually broken into two types.
Current assets, cash, or things turning into cash soon.
Exactly. Cash itself, retentions money clients hold back. Accounts, receivable money clients owe you for finished work.
Getting those receivables collected quickly must be key.
Absolutely vital for cash flow. Also in current assets, inventory materials you have on hand, and prepaid expenses, things like insurance paid in advance. Keeping inventory low is usually smart too.
And fixed assets, the long-term stuff.
Yep. Vehicles, heavy equipment, buildings, maybe major office improvements, things you use over many years.
Okay, then L, liabilities.
Weird.
What the business owes.
The debts, also usually split into two types.
Current liabilities. Debts due soon, within a year typically.
That's right. Accounts payable what you owe suppliers, subs, notes, payable short-term loans, accrued expenses, regular bills like utilities, advertising, payroll owed, taxes owed.
Keeping suppliers happy by paying accounts payable on time seems important.
Very important for relationships and credit. Then you have long-term liabilities.
Debts due further down the road, like loans for those fixed assets.
Exactly. Loans for trucks, equipment, property.
And finally, E, equity, the owner's stake.
Yes, also called net worth. It's simply the difference between total assets and total liabilities. What's left over belongs to the owners. And the core equation, why it's called a balance sheet, is assets, liabilities plus equity. It must balance.
The car example helps there. Core work, $10, asset. $6K bank loan liability, plus $4 is your money, equity. $10, $6K, plus $4, it balances out.
Perfect illustration. And that equity piece, the $4 in the example, that's the most important part from the owner's perspective. It's your piece of the pie. If assets only equal liabilities, your equity is zero. You own nothing, essentially. Looking at a sample balance sheet, you see current assets totaled, fixed assets totaled, then combined. Comparing that total asset figure year to year tells you if the company is growing its base.
Okay, tied into those fixed assets is another concept, depreciation.
Right. It's just accounting for the fact that trucks, equipment, they wear out, get old, lose value over time.
But there's a benefit to tracking that loss in value, a silver lining.
There is. Depreciation is counted as a business expense, and expenses reduce your taxable income, so less tax to pay. It's a non-cash expense that saves you real cash on taxes.
And there are different ways to calculate it. Straight line.
That's the simplest, cost salvage value. Useful enough, same write-off amount each year. Easy, but once you choose it, you're usually stuck with it.
The other one, double declining, gives you bigger write-offs earlier.
Correct. It's accelerated. Bigger expense deduction in the first few years, smaller later on, can be good for cash flow early or managing taxes. And you can switch from double declining to straight line later, but not the other way around.
Definitely sounds like something to discuss with an accountant, which method fits best. And this reduces the asset's value on the balance sheet over time.
Exactly. The asset's book value goes down each year by the amount of depreciation taken.
Okay, so balance sheet is a snapshot. The other main statement, the income statement, shows performance over a period.
Precisely. Profit or loss for a month, quarter, year. How did the business do during that time?
Also called P&L, right? Profit and loss.
Yep, or income and expense statement. All mean the same thing.
It starts with the total income, net sales.
Right, all the revenue you brought in from jobs during that period.
Then you subtract all the costs of doing that work, the expenses.
Exactly. For contractors, the big ones are cost of sales, mostly labor and materials directly tied to the jobs. That's usually the largest chunk.
Then there's overhead, costs just to keep the doors open.
Right. General administrative, maybe owner's salary, office staff, and general operating expenses, insurance, phone, rent, supplies, advertising, costs you have even between jobs.
So net sales minus all those expenses equals
Operating profit, or income before taxes. This is a super important number. It's like the business's grade on operations. How much profit did you make before taxes? You have the most control over this through pricing and cost management.
After that, you account for the tax man.
Yep. Subtract the tax liability based on that operating profit.
And what's left is the famous bottom line.
That's net profit, or just net. After all expenses and all taxes are paid, this is what's actually left over for the owners or to reinvest. Comparing that net profit figure year over year on your income statement is crucial. Is it growing, stagnant, shrinking? That tells you the real story of your business's performance trend. Now let's talk about something absolutely vital day to day. Cash flow.
Ah, yeah. You can show a profit on paper, but still be unable to pay bills if the cash isn't actually there.
Right. Exactly. It's about the actual movement of money. Think of money coming in the front door, your current assets, cash, receivables, and money going out the back door, your current liabilities, paying suppliers, payroll, loans.
You need more coming in than going out, obviously,
Well,
with some left over.
precisely. And that leftover bit is critical.
Okay, this sounds really important. What do we call that leftover cash buffer?
That's your net working capital. Simple calculation from the balance sheet. Current assets minus current liabilities.
Okay, so if current assets are, say, $250,000 and current liabilities are $180,000.
Then your net working capital is $70,000. 250K, 150K.
And that 70K, it doesn't just sit there, right? It's not mattress money.
Absolutely not. That's why it's called working capital. You put that money to work.
So?
Use it to generate more money, buy more equipment to do bigger jobs, hire more people to handle more volume, take on projects with higher upfront costs. It fuels growth.
It's the engine. The money you use to make more money.
That's the cycle. Generate cash flow, build up working capital, reinvest that working capital strategically to increase revenue and profit. Understanding that is fundamental to building a sustainable business.
We've hit licensing, structure, qualifiers, funding, and the core financial statements, balance sheet, income statement, and this crucial idea of working capital. It's a lot, but seems like the real building blocks.
Knowing this stuff really empowers you. You move from just doing the work to actually managing a business.
So thinking about everything we've unpacked, assets, liabilities, profit tracking, cash flow, if you, the listener, had to pick just one number or metric from your financial statements to watch like a hawk in your own business, what would it be and why? Something to chew on.
Yeah, definitely take these ideas back, look at your own situation or materials you have, and seriously, don't hesitate to get professional advice from an accountant who gets the construction world. It's worth it.
Absolutely. Well, that wraps up our deep dive for today. Thanks so much for exploring these contractor business essentials with us. vpod.ai, your source for information. This podcast is sponsored by Stonefly, your trusted solution provider and advisor in enterprise storage, backup, disaster recovery, hyperconverged in VMware, Hyper-V, Proxmox cluster, AI servers, and public and private cloud. Check out stonefly.com or email your project requirements to sales@stonefly.com.